Sorry to keep you guys waiting there. I'll be with you guys. I mean, I'm just checking on the sound to confirm everything is okay. All right. I guess I am.
Hi.
Hi there.
Hi. Hi.
Hi
Yeah.
there.
Yeah.
Am I?
Sorry about this. Yeah.
Yes.
We are live now, and you can
Okay.
start.
I can
Yeah.
start. Brilliant.
Yeah.
Okay.
Thank you.
Very. Yes, brilliant. Thank you very much for that. Okay, thank you. Thank you, FX Street, as well. And thank you, guys, for coming to today's session. A very good afternoon to you guys. Good evening, as well, to those far away in the East. I'm here today. My name is Kenny Simon from Orbex. I represent Orbex as the head of education. And today I'll be presenting you quite an interesting topic. So I shall then present you this slide here. And today is the 27th of September 2016, and I'm here to present you a interesting presentation on gold status in today's economy. So it's got to do with pre and post presidential elections as well, and a couple of things that would help you understand what's going on in today's economy. It's a lot of conundrums, a lot of things that are going on that is confusing traders as well as investors. You and me alike, we're all wondering what exactly is going on, whether gold is going to make that final comeback, whether it is worth for us to look into gold at all, and what's going on with the dollar, and whether or not what's the geopolitical factors as well as what's going on with the US economy, would it then give about or give out some opportunities and hint us on how we can then measure our risk and our exposure to the markets. Okay, so this is what I'm here for today. So I hope you enjoy this presentation, and we'll shall get to it. And I'll just give me a second to enlarge this presentation slide. As you can see, give me a second, guys. Okay, there we go. All right. Okay, before anything else, I'll just give you my personal observation of the current market, me as a trader and educator myself. So we're looking into market sentiments. As I've mentioned earlier on, quite a number of people um, wondering about what's going on, and there's been a lot of talk about dollars crash, the collapse of the U.S. economy. Things going downhill in terms of how the political economic side of things are going on. So in terms of market sentiments, I see lots of fear and uncertainty, mix matching between the two. Okay, so there are even talks about exact dates in September. Some of you guys may be wondering. A lot of quite a number of videos online been produced, as well as interesting articles talking about September the 23rd, September the 27th, a couple of things, a couple of dates that were actually mentioned and highlighted to be when the dollar would crash, when the economy would crash, and things like that. Okay, so there are also questions about precious metals, as I've mentioned earlier on. And together with all these things, we've got the US presidential election, and the first US presidential election, first debate actually started. And this is what we're going to be looking at, how the market is revolving in that area. Let me just check onto the screen. Give me a second, guys. I'm just going to be making sure that I'm showing the right thing. Okay, give me a second. Let us just double check there again. I would like to show my screen there. Okay, let's just check it out here. Okay, I think I'm showing my screen just now, just to confirm. Yes, there we go. And this is my presentation slide. As you can see, market sentiments I've mentioned, you've got a mixture of fear and uncertainty, more of a confused state going on at the moment. But I would like to go through with you a couple of topics that would then give us a bit of a guideline of what we can actually talk about today, as well in relation to the hot topics that are mentioned, whether it's media, radio, even on articles and various other sites as well, top sites in the market that we as investors would be actually reading on. So here we've got, as you can see, a first bulleted point talking about the dollar crashing, economic collapsing. Then we've got the debate has gone on. So we're talking about what would the new president would bring about between Trump and Hillary. Then we've got something interesting in the 1st of October, where yuan will actually get included into the SDR basket, the special drawing right basket of currencies. So it'll be the fifth currency together with the other currencies. And then finally, we've got gold and silver. What's going on? There are a lot of talks about silver overtaking gold, if at all it's going to rise. Both precious metals. And it's a question of when as well, with regards to gold, if at all we're expecting. Why is it? We'll also be talking about why is it that gold is set to make a comeback. There's a lot of potential to the upside. It's just not happening just yet. And there are reasons to that, and a couple of things to talk about with regards to paper gold and physical gold, as well as manipulations or market manipulations. Okay, so these are things I'll cover as well, just so that you get a bit of an idea of what exactly is going on in the market with gold, with gold's position. And there are a couple of other areas that would sort of a spillover of post-Brexit as well, and the after effect of it, or what's happening as of now that would actually impact the markets. And then we've heard a lot about banking crisis, especially in Italy. Would it then become sort of a dominoes effect? Any high hopes on repairing that scenario? Whether or not the ECB or the European Commissions, have got some plans to actually look into that. But our view would actually be more into the gold and the US dollar status, and a couple of areas to talk about. I would also include why gold, and we'll talk a little bit about how gold would be an insurance, and how constant it is, as well as resilient, and a couple of stories and pointers to share with you today on that. Okay, so we'll just go through the couple of other slides as well. Give me a second. Okay, I'm just going to slides a little bit better. Okay, so we've got now the thing about the questions regarding gold and silver is a bit of a misconception going on as well about gold. Whether or not it is actually gold that is going up and down, but apparently, there are other things that we would need to realize, that gold is very much controlled by the movement of the dollar, and the dollar, as you would have known much better, especially as investors and traders, is that it's got a lot of geopolitical interference or factors at the moment that is causing what's going on with the dollar, as well as currencies that are sort of pegged to the dollar or influenced by the movement of dollar. Okay. Now the other thing as well is, there's quite a number of talk about bubbles. What sort of bubbles? We've got bubbles that are said to be going on at the moment, and I'm just going to try to move my slides a little bit better. Okay, mention about that. Let us just okay. And as I've mentioned about bubbles, we've also got, a couple of things here to share, and I've got it on my presentation slide here. And a lot of us have been informed about the property bubbles as well as the bond bubbles. And now apparently we are into a stage of a one of the biggest bubble that is about to explode or burst, and that's the derivatives bubble. Okay, and with that, we've got the Federal Reserve or central banks play into the market, and then just recently we're listening to how banks are actually manipulating, prices as well. Especially with gold prices, precious metals, and then the mixture with currency war news and things like that. So as a lot of things has been going on. So as I've put it on my slide here, as you can see, I mean, just recently, as of I think a day before yesterday, as of Sunday, a couple of news been released or articles about how the property bubble or housing bubble of China is worsening at the moment, with policy options running out, as you can see on the article. So this is what's going on at the moment in China, and we'll talk a lot about how the interplay between Chinese economy and the U.S. economy, or Chinese GDP and the U.S. GDP, sort of correlate, and how apparently there's a bit of a love-hate relationship between the two countries, but there's a lot of need factor between the two as well. The balancing it out is a inner game of play that would balance out the whole mechanics of economy as a whole, even the global economy. So these two countries are the major engine of this whole mechanics as well. Okay, so this is what we need to realize, that these are important things that we would need to know about, because they sort of come out as a surprise to us, especially retail traders sometimes. And for those who are very much just into the trading side of it, whether it's technical fundamentals and sort of follow a routine regime of trading, they usually get taken by surprise of what, big moves and all that has not been announced, let's say. So these are areas that I want to actually share with you, so that you get a bit of an idea of what's going on, a bit of surprising news, a bit of surprising facts that are going on with not only the bubble's current economic, but what the Feds are doing, the way that they are actually working behind the curtains between countries as well, what they're gearing up in doing. That all would have a big impact onto the economy. And now, because we're talking about gold's position as well, it would actually have a direct connection with gold's prices, and gold's the speed of how gold would actually rise up, or how much it would actually rise up by. You see, so these are important elements that we would need to know about. So this is what we'll talk about. Now, we've got, in talking about bubbles, of course, here I've got the Chinese bubble here. As you can see, this very interesting Dow Jones sort of line as well, in comparison to the Shanghai Composite Index as well. This has been supplied by the Yahoo finance side of things, or research, and it's an important what do you call that, area to sort of understand. And that as well has got a big connection with New Zealand property bubble. And I mean, with what's going on in New Zealand as well, we have got a huge or a growing number of affluent Chinese clients that are also making up that statistics of property owners in New Zealand. So there's a bit of an interplay, not only with the bubble bursting, but the whole what do you call that, root cause, or sort of driving factor would come from a single country like China, let's say, and a couple of other things. So they all actually relate, and there are connections everywhere, even though they're just far away, New Zealand and China. But then you've got people from there, and there's a lot of transfer of wealth as well as going on. So the bubble, the sub bubbles as well travel, and they all connect, and this is an interesting play of what's going on at the moment. And we've also got this is going on with the, again, housing bubble in Canada, a couple of other areas, like British Columbia, Vancouver, and all that. and they're actually warning, giving warning signs. But compared to the other housing markets, I mean, Canada, it looks like they've got a bit of a control factor. They're in control of the situation as far as we hear them say. But this is basically what they have mentioned about having more of a strategy compared to that. Okay, with New Zealand, I mean, they are comparing with what is going on in Singapore and how Singapore have actually capped or controlled that housing bubble from bursting as well with the various policy changes. But they're not saying that that is exactly what's happening in New Zealand. So perhaps there's more to come, more to come in terms of all these after effects of a burst or even just about to burst sort of thing in New Zealand. Then we've got the bond bubble that they're talking about. They are just bond bubbles. Bonds itself are IOUs. So here itself, it's clearly shown how the climb or the rise up of bubble to the 13 trillion sort of figure as well. So this has been provided by Wall Street Journal. Okay, this little diagram or illustration that you can see. Okay, and here we are talking about the mother of all bubbles, as have been mentioned many times about derivatives. And derivatives are just, all their loans, any sort of loans, most of the most common loans, housing, mortgages and all that being lumped up into a product. And the derivatives has been seen or been talked a lot about to be similar to a casino. They're actually betting on all these products and then lumped up this product into a sellable or very marketable product that has gone into the 500 plus trillion-dollar value, and that's how much will be impacted if at all that burst. Okay, that derivatives market. So this is all the gameplay at the moment. Now, with all the bubbles that I've talked about, I mean, it's interesting. It is important for me to talk a little bit about the stages of a financial crisis, or how what would the route be, or the whole path for a bubble to burst, and what are the stages it takes before that bubble bursts, because then it would give me more how do you call that, more information to share with you on how relevant is it to either own gold physically or invest in gold. Okay, and how good the investment of gold is, just by understanding which stages we are at, and how the workings of policies and monetary policy and all that would then affect your investment interest in gold. Okay, so these are the things. Now, you tell me whether or not there's commonness or familiarity with what's going on now at the moment with our economy, or the stage that we may be in. Okay, and let's start with this, and I'll give you some examples in a bit. Okay, we'll start with usually it starts with an asset class rise. Okay, we can talk about this asset could be, let's say, the housing bubble, or house prices going up. There's a lot of interest in there. Okay, let's say we're talking about what's going on in New Zealand at the moment, or even Canada. Okay, and this is where we have got loads of interest going into the buying side of the buying side. Okay, because that's where the interest lies, and this usually happens, I mean, the bubble rise, or when, as and when the bubble is just growing, and you've got all this collection of investors into that asset, it's usually the time of low interest rates. Now, I want you to ask yourself whether or not this is exactly what's going on at the moment. I mean, even if it is in New Zealand or in Canada, what's the interest rate like? Has it been lower or in low times compared to all the other times? Okay, and you've got the low interest rate times, low interest rate levels would be the first sort of stage that it would start off with that first stage. And then once that goes on, and then you've got more buying interest, and things are just looking and sounding really rosy, then you have got more and more experts, politicians, are being interviewed, and then you've got these anchors on media, TV, like Bloomberg, CNN, and all that. They're giving you all the great news about how good, how wonderful this investment is, all these opportunities, and that sort of would sink in into the subconscious minds of investors to hurry up, to hurry up and grab that wonderful opportunity before you miss it, kind of thing. So that would be the second stage of a bubble to be. Okay, and then what would then happen is we would hear of the wonderful news or plans of the bigger boys of interest rate hikes. Okay, so this would then be a sort of means to further convince or increase that confident level as well. So this is between the stage 2 to 3. Usually, you've got all these investors going through a wonderful shower of irrational exuberance as well, thinking that I can only go up. And it's impossible that it would just crash and all that. It's just too strong and it's just too good to actually come out now. So this is where stage 3 is. Okay, then this is sort of psych that it would communicate to investors and traders. And then we have got a bit of a burst of bubble in terms of the emotions of investors, where the economy would go into a slowdown. Okay, that's the curve bit, where a curve of the, like a bell curve, where it starts to slow down at the very top. So that would be stage 4. Okay, so this is where I'm looking at what's going on now, and of course, we've got a lot of manipulation of data, as I've mentioned earlier on. A lot of people are talking about it. It's on news, and then we've got this NFP recently, and a lot of traders and investors would be how do you call that, expecting it to increase, and suddenly all that being blown back at you, and it goes against expectation and things like that. So economy, I mean, in the US, and there's a big contrast between what's a reality in the States at the moment, with loads of job cuts and a lot of things are going on the negative side, but then it's total opposite with what had gone on news and how things are portrayed through the economic data releases and everything else. Okay, so reality usually counts much more, because it's just impossible to hide everything and sweep too many things under the carpet. So then when that comes out, then it would hint, it will give clearer hints of recession or deflation and all that, and then people start to react. We'll talk a little bit more about adaptive behavior in a bit. It's a branch of mass ecology as well, and things like that. So you would get an idea of how it's quite contagious, the whole mass ecology of trading behavior or financial decision making, but it's more adaptive psychology. Okay, where they just follow the crowd. Okay, so that's when it happens. That's for fourth stage. Okay, the economy slows down. All right, now usually what happens is between the third to fourth stage, a little bit later than the fourth stage, is usually quite close to a presidential election. Okay, so a presidential election is exactly what's going on now. We're close to that stage, and not far from the presidential election is when we've got a bit of a gap between the time now to the time that the bad news really is not really, it's beyond bad news, it's the bubble burst time. So you guys think about it, and this has been going on for some time, many years back, where the cycle has been going on following stage 1 to stage 6, and we are very close. We're in between 4, 5, 6 now in terms of the stages that we're in. So you guys could also think about it, and look around you and see whether or not there are hints that would actually mirror these stages. Okay, so it's an interesting observation. Okay, these are the stages. So what would you think about it? Okay, now I would like to then straight dive into gold, okay? And I want to dive into gold and talk to you a little bit about the three elements that would make what you call that gold something that you would think about positively as part of your portfolio, okay? And why would I personally think about gold still giving us some opportunities very soon, okay? So let's talk about the first element of gold being an insurance, okay? Now, goal is nothing but just an element, okay? Of course, if for those who who studied physics and chemistry and all that, sorry, you would then think about the atom number 79, okay, as gold, just an element. Now, it's not, I mean, in my perspective, gold is not an investment, okay? A lot of experts researching this as well would agree that it's not even a commodity. It's not paper, of course, and it's not digital. Okay. Now, gold is very, to put it very simply, it's insurance. Why? Because it's insurance against current economic condition, and of course, like we're in at the moment, it's unstable monetary policy. Okay, so this is what gold is in this what you call that element of insurance. Okay, now we've got something that we call an anti-complex asset, and that is what gold is. So it's closer to being an insurance, not close to being an insurance. It is insurance because it's an anti-complex asset. Now, we live in a complex world, but the way the economy is running at the moment by the Feds or by superpowers in economy, getting opinion from the economist and all that, it comes from a equilibrium system. I mean, the countries, let's talk about the Fed, let's say they run the country or the economy based on an equilibrium system. Okay, an equilibrium system, I'll just explain what a complex model and equilibrium or an equilibrium model is. Okay, so I'll just put it really brief for you to understand. Now, equilibrium system, like how Janet Yellen would be running, excuse me, the whole show at the moment with economy and everything else, is as though she's sitting in the cockpit of a plane or of an aeroplane, where you can actually adjust certain parts of the plane. You either go up or down. So that's exactly the case with pumping money in, increasing rates, interest rate or so, or pumping in QE and all that kind of thing, stimulus, whether depending on rate of inflation, growth in the country. So all that is basically an equilibrium system. So they have a structure, and they have rules and things that would tick some boxes, and then they'll do that certain thing. So that's an equilibrium model or system of working, or even the economy mechanics. But a complex model is when you could imagine that whole plane that they're flying would actually just turn into a bird or a butterfly or something. That's a complex system, and that is exactly how a complex system is in an economy, okay? Because there's a couple of things that we call it as conditional correlation, because sometimes we've got certain things that a group of investors would then create ripples that are not even connected to how it works, and it suddenly cause other things to happen, or even other bubbles to happen, and that is a complex system. So an equilibrium model, in my opinion, like what the Fed or most central bankers are running, economy of today as well are running on, wouldn't actually fit a complex world like what we are in, a complex economy, okay, or a complex global economy. All right, so this is how I see it as well. And the economy is definitely complex, and we've got something called a critical threshold as well. A critical threshold, it's something like this. When you are in a cinema, let's say, or a theater, or in a place where there's a big crowd, or let's say a stadium where there's a game on, a game of soccer or baseball, and and then you've got one or two person suddenly just get up or got up and ran ran out of the stadium. You'll just probably just look at that because in that crowd, that two people wouldn't actually show you much of a wouldn't create much of an impact or adapt or how do you call that, just make you behave that way or make you follow them and run out together. But what if you've got just hundreds of people in different areas just got up and start rushing out of the stadium? That would then be an adaptive behavior model, which is what's going on in our economy, where we've got mass psychology, what do you call that, in control. Okay, so when the critical threshold is more than two and sorry, less than two, and it's actually more than 60, is a bit of a formula going on. Then you have got that what do you call that, that happening. Okay, you've got that group of people who manage to then control a bigger crowd or a bigger behavior of crowd. Okay, so that's a complex model of working, and this is what's going on in our economy today. Okay, so especially we call it complexity in capital markets. Okay, and this is what's going on as well. If at all you've got 100 million investors that are actually what do you call that, influenced by certain things, then you have got more and more what do you call that, pool of people just getting attracted to it to actually do what that 100 million people are actually doing. Okay, so this is what's going on, and I would like to talk to you about that complex model, and hence the reason why gold is actually seen as an insurance to that, because gold would actually then survive in a complex world as well, because it's got its whole measured asset valued in a fixed way. Okay, so the dynamics of it would actually work very well. Okay, so that goes with housing bubbles and everything else, trade balance losses, and all these things would then give us more reason to believe that gold would give you insurance against inflation, deflation, and in today's economy. Okay, so this is the number one point about gold being an insurance. Okay, now what do I mean with the second one? It's quite an interesting point. Gold has got a constant measure. Okay, this one here is insurance, and then we are moving on to gold being persistent or constant. Okay, and what do we mean in that? It's constant in its measure. Okay, now people usually talk a lot about gold going up and down. Of course, like us, traders, we will talk about gold rising, making a bit of a rise, and it's time to buy because it's going up or down. Now, in my opinion, I think gold don't actually go up or down. It actually, it is the value of the dollar that actually goes up and down, and that is the means of control for gold. Okay, so if you've got gold, let's say from an ounce of from $1,200 an ounce, have actually risen to $1,300, then that actually mean that the value of the dollar has actually fallen, and hence reason for it to actually uh, risen. So it's a lot to do with how it's controlled by the movement of the dollar. Okay, so this is actually quite important for us to understand. It is, because a lot of people are talking about prices, even prices of goods. There are false assumption talking about how gold is driven by supply and demand. Demand goes up, supply goes down because of, and vice versa. And so a lot of them would actually ask, if at all, demand is actually going up for gold, then why is it that gold's not actually responding? Okay, so that false assumption as well has got a lot to do with what's going on in the world with regards to the physical gold versus the paper gold. Okay, now the paper gold market, of course, they're made of different contracts. You've got the COMEX futures, you've got the ETFs, which stands for exchange traded funds, you've got gold swaps, you've got forward contracts, and something really interesting nowadays. I mean, you've heard about what happened to Deutsche Bank. There were times that, they talked about this term. It's a buzzword nowadays, allocated gold. It's just gold that you don't own. You own it on paper, but most likely, most probably, you cannot actually claim that amount of gold for what is shown on paper. Okay, so that is really, really interesting. That's what's going on at the moment. Okay, so paper gold market, to be honest, I think it's about, there's a lot of claims saying that it's about 100 times bigger than the actual physical gold market. So most likely, if you've got 100 people having that paper and gold, you've probably got one person out there, 100, let's say, who could really claim their gold on physical form. Okay, so this is an interesting point. This is what we've been talking about a lot for previous webinars as well, and in various articles, and now it's just coming to fruition. There's a lot of evidence that are actually just coming out, from the incident with Deutsche Bank, Commerzbank, a couple of other banks as well, and this is what's going on. Okay, and more people are given, how do you call that, more and more people are sort of being aware of this whole factor now, and that's where the fear factor is coming in. And as I've mentioned earlier on about the adaptive behavior as well, that's influencing the behavior of sell-offs by investors and traders, and how they're actually reacting to the market. Okay, so this is something that we would need to be very, very aware of what's going on. Okay, so we've also got, even central banks are also taking back their gold. I mean, there are cases where Venezuela took back their gold. We've got Germany took back their gold from Frankfurt. Then Azerbaijan as well, took back their gold. These are central banks who took back their gold from Baku. So all these things hints that there's a problem going on with physical gold versus paper gold, and these are solid problems with evidence that are actually going on as we speak today. Okay, and the problem with that, I mean, we're talking about problem, and the biggest issue with gold is is issue with more buyers and less sellers. Okay, so with the problem of having more buyers, when you've got an incident or a scenario where you've got more buyers for gold, less sellers, if at all you're a broker, imagine yourself as a broker and you would like to buy this gold, you would need to buy it directly from the refineries. Okay, so the refineries, buying it from the refineries itself would have a bit of a delay with the delivery time as well, because you would then take up time for the delivery and the ready of that order between 5 to 6 weeks, more or less. Okay, and this is giving us more hints of tight physical supply. Okay, so this is one of the main issue at the moment, and again, it would give us more, how do you call that, evidence that gold is constant compared to what's going on around it, that is actually causing it to be even higher in demand. Okay, so its measure is still going to be constant, because what's going around has got elements of geopolitics. It is the dollar and everything else, but gold as it is remains gold. Okay, so it only reacts in terms of the price based on what's surrounding it. Okay, and you've got all this gameplay going on, and that's what's making gold's price up and down. Gold on its own does not go up and down. Okay, so that's basically it. And yes, and I've mentioned about tight physical supply as well. And we've also got, when you talk about gameplays, um, how the economy is working. We've also got, gameplays by specific countries like China, like Iran and Russia, as you guys probably have read about it they have been stocking up gold, quite a lot, and over the past years. And we've got China, for example, being one of the major buyers of gold. But the issue there is the issue of transparency of how much gold do they actually have. I mean, since 2009, the first time they've ever actually made a formal report to the IMF stating the amount of gold they've actually got held in their reserves, their federal reserves, so their reserves, yeah, and they've actually updated it at the time in 2015 at 1,658 tons. So that was what they say they've got, but through evidence as well, at for the past couple of months or so, we've got more evidence in believing that China could have much more than that reserve, because there's this agency that they actually hold China's gold, and they're called safe. Okay, of course they keep their gold in safes, but the safe that I'm talking about is an agent that China uses to hold huge gold reserves. And SAFE stands for the State Admin Foreign Exchange. This is the agent that China is using at the moment to actually hold their gold reserves. Okay, and holding their gold reserves, I think it would actually be much more than what we hear of 1,658 odd tons, and this would then be, my guess is, so are experts talking about it, close to the 3 to 5,000 tons extra. Okay, so China, having that hunger of accumulating gold would only be relevant if they've got a plan for it. And China has a plan indeed. And gold, it's got to do with their gold to GDP ratio. And the goal to GDP ratio is something that they've got a target to achieve. Okay, they would like to increase that, and the goal of to GDP ratio would most probably be reached once they have a total gold reserve of about 8,000 tons. Okay, so hence the reason for gold to be low, and the yuan to be low, and the inflation as well. So all these three worked out together. So there's a bit of a play where they are working hand in hand to keep their yuan really low. Okay, their inflation as well, with the United States buying, trillions worth of dollars from trillions of dollars of the U.S. Treasury as well, and U.S. Treasury bills. And this has got a bit of a mechanics going on to keep the yuan really low, because if the yuan and the inflation goes up, that wouldn't be good for China before they reach the gold to GDP ratio. Okay, so this is the plan that they may have. I'm not sure, but a lot of research have actually proven that this is the inner working or plan between China and the States to actually be good friends once they have actually reached, once China have actually reached the GDP gold GDP ratio. Because the one thing that I would like to point out as well here is, China is a secret friend for the United States, especially in absorbing U.S. debt. Okay, in buying those U.S. treasuries, they are absorbing U.S. debt. Okay, so there's a bit of an interplay going on as well, a covert operations, as we call it. Okay, so China is buying quietly. They're not really telling you out and out aloud of what really they are buying and how much of it. Okay, so I mean, in their idea, probably they would like to keep it quiet as to not as to prevent wild jumps in the market. Okay, because orderly jumps in gold is okay for the government, like even the Federal Reserve, but unorderly jumps of gold, excuse me, it's a big threat for the Federal Reserve. So if it is going on steady up rising, it's fine. But if it's got what do you call that, big jumps, and it adapts the behavior of investors, and then it grows to having a bigger impact, that is when it would motivate governments, treasuries, sorry, the feds especially, to actually intervene, or in other words, manipulate the market. Okay, we'll talk a little bit more about manipulation of the market as well, and just a little bit once we talk about being resilient, goal being resilient. Okay, so this is basically it. I mean, there are talks about Russia, Iran, Turkey, and Jordan as well, buying more and more gold. I mean, their buying power for gold has actually accelerated as well. So that is pushing demand up, definitely. Okay, then when I've mentioned a little bit about how buying of gold would actually be from refineries directly, let's talk about some of the largest refineries in Switzerland. Okay, they're based in Switzerland, and they are actually at this moment of time working harder, much more in terms of hours in producing this gold. And it could be working easily 24 hours a day. And what they're doing is to produce a sort of a leverage or average tons, 20 about 20 tons a week or so. And half of these production per week would actually go to a large extent to China every week. So we've got a total of about 500 tons a year, okay, to China alone. And this is what's going on with my researchers as well. I would point out these things going on even as we speak in Switzerland. Okay, the only thing is that we've got these refineries, trying to balance up their books and not to offend their big clients like Chopard, like Rolex, and all this jewelry. What do you call that? Big boys in the jewelry industry, because these are long-term clients. So there are times that they're not able to say a total no to the Chinese, or a total no to their long-term clients as well. So this is an issue that is faced by the refineries as well. Okay, now the vaults. When you talked about storage of gold, I mean, there's a lot of news talking about how storage of gold in various countries in top areas, the vaults are actually owned by the Chinese. So we have got these things as well, that we need to understand, whether or not this is part of the plan. All these little things that are going on, are they part of the plan, especially by the Chinese? Because we have got vaults in Switzerland, for example, those storage places, logistical vaults and all that. They're actually in the midst of negotiating with the army in the Alps mountains as well, to actually use military bays that are, usually tunnels and chambers for weapons, artillery, and all that, to actually use them as storage space for gold. Okay, so this is what's going on. You can always look that up. It's not easily available information, but they are out there. Okay, so you've got so much demand, but then people are still asking why. Why is gold still not showing off its moves upwards? Okay, still you've got massive selling. Now the massive selling, through futures, unallocated gold and all that, it's mainly due to a tug of war. Okay, as I've mentioned earlier on, between physical and paper gold. Okay, and that is what's causing the volatility. Okay, as you know, volatility stands for fear and uncertainty too. That's what the VIX index is for as well. Okay, so the what's a tug of war about? This tug of war is a pull on one side with the other side. So you've got central banks, hedge funds, you've got bullion banks and all that. They're on one side pulling it. Okay, and then you've got the other side made of the large buyers and individual gold investors pulling it on the other end. So you've got this, pulling, uh, 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 pulling of ropes basically. So, but once that rope actually breaks, then any hints of issues or problems about the delivery of these gold would then make gold price burst to the upside. Okay, so this is how it works, and this is what basically is sort of happening. This tug of war is happening. There's a lot of pulling, a lot of news about all these manipulations going on. So this is basically what's going on now. The manipulation, as I've mentioned earlier on as well, usually happens when central bank does realize that it goes up, and it's a disorder rise out of gold. So I want to talk a little bit about the manipulation that has actually gone on. I mean, in history itself, we've got the London gold pool made up of West Germany, UK, and US. Okay, this makes up the London gold pool in the 1960s. We call it gold dumping, and they've actually all pulled up together to actually sell off gold. So that's how it has actually pulled the price of gold, because they've known it to actually make big jumps up. So they need to intervene, and they want to manipulate. So in 1960, they've done a major gold dumping or gold sell-off. Okay, back in after that in 1974, as well as the 1980s, we've got the USA, for example, in the States. They have actually sold about 1,000-ton gold, and then you've got the IMF 700 tons. Okay, so in these 2 years, they've sold that much, total to about 1,700 tons of gold being dumped. That means it's just manipulate the market by selling off these much of gold. Okay, it's a lot of gold. And then recently, 2010. That's quite recent. 2010, IMF itself, they've sold off 400 tons of gold. So the easiest way to actually manipulate, talking about manipulation of paper gold, is through COMEX futures, of course. Now, there's a new play in the market of this manipulation as well, and these are hedge funders. Okay, hedge fund companies, they also sell, but they play it in a very systematic way using their stop loss limits. Okay, so once the what you call maximum amount gets what you call that gets hit, they keep on selling, and the other companies as well will sell from that point where the stop loss have actually hit, and further down goes the price of gold. Okay, so that's basically how it sort of works. Now, behind the manipulation, besides hedge funds, of course, you've got the LBMA banks. Okay, the London Bullion Association banks, and these two basically make up the major player behind the manipulation as we speak. Okay, this is what's going on every time. So we would like to also, point out that we've got larger political and policy makers as well. Okay, and the net importer USA as well as China. These are the main big players that suppresses gold. So China, as I've mentioned, they've got a bit of a love-hate relationship. They own trillion of US Treasury. So China, again, they absorb the US debts a lot. So in other words, in summary, US needs to accommodate China's US accommodates China's need. Okay, they do that. And the Federal Reserve, very easy. They they almost always they want a weaker dollar. Okay, because they are desperate for inflation. So weaker dollar equals inflation. So let's say we've got an equation going on whereby if you got cheaper dollar, if you make your dollar cheaper and cheaper and cheaper, devalue them, then your imports go up. Now, when imports go up, they've got their goals reached, whereby their inflation goes up as well. Okay, so this actually is a good thing for the states, even though they'll say otherwise or market otherwise. But then this feeds their supply chain in the United States. So an equation globally would be like this. China. Let's say if there's a problem if China's inflation goes up. So that's why keeping the yuan really low and everything low. So if at all if China goes through inflation, or the inflation breaks out, what would happen then? China needs to then sell their U.S. treasuries. Okay, so once when U.S. Treasury gets sold off by China, then the interest rates in the U.S. goes up. This is when gold would then go up too. Okay, so the interest rate goes up, then you've got dollar. Sorry, you've got a dollar up, then you've got dollar down. Okay, if not, it's the other way around. So when interest rate goes up in the States, you've got a dollar going up, then you've got the gold, either a correction or so, but it's got sell-offs in gold. Okay, but when this does happen, if at all you go into the market and then you listen to news and then you see that the China inflation, breaks out, then there are higher possibility of U.S. stocks and housing crashes as well. Okay. Okay, so this is basically on the insurance side of it. I'll not go too deeply into the resilient part because I would like to take you through now onto the chart to look into some patterns, if I've promised, on geometric patterns on gold, a couple of other pairs as well. Now, with regards to resilience, gold does indeed have got resilience, okay, in especially in a deflationary world. This is how I term the world today. Deflationary world with cyber warfare, you've got bubble bursting and everything else. Gold is indeed resilient. I mean, let's say, for example, in August 22nd of 2013, we've got a Nasdaq that have actually shut down for about a day, if I'm not mistaken, and a lot of people have actually mentioned rumor actually went around saying so the Russian were actually hacking the system. But it's only in 2014 that the Bloomberg headline read NASDAQ hackers, and there were more news about all these things. So whether or not it's true or not, it is definitely a very, very unpredictable world. We don't know who the players are exactly, and that's why there are more reasons to actually own gold, because it's not digital. Gold is digital problem through cyber currency warfare and everything with cyber brigades and everything else. But gold, at the end of the day, is resilient because it's not digital and it cannot be hacked. Okay, so that's one point that we need to be aware of. Okay. China basically has got about 2 trillion US dollars. Okay, I mean, we're talking about the reserve position, their national reserve. Let's say they've got 2 trillion plus US dollars. Okay, no, sorry, they've got about 3.2 trillion in total. Okay, it's made out of gold, euros, and other assets. Okay, the 2 trillion are US dollars, okay, and then the remaining are made out of gold, euros, and all that. So what they would like to do or achieve is to actually increase the amount for gold, okay, not have much more what do you call that, fiat currencies, just the dollars and all that in their reserve. They would like to increase the gold side of it because it's resilient. Okay, so gold will be always better. Now, emerging markets, for example, like Jordan, even Malaysia, Philippines, and Vietnam, they have actually been increasing their gold reserve. Mainly, why? Why are they actually doing it? I mean, if you were to interview them, the big boys in these emerging markets, they wouldn't say it out loud, but the main reason, I would guess, is to hedge against dollars instability. Okay, so the decision, by the Fed as well, maybe, because a lot of people say that the decisions by the Feds or the US are actually, the ones responsible for financial crisis, especially in the emerging markets. Okay, so you've got the 19, let's say, for example, these things about emerging markets, a lot of them are also talking about how in 1997, I think, if I'm not mistaken, right up to 1998, we've got a capital markets collapse, okay, and that was like a dominoes effect. It started, for example, in Thailand, and then it went to Indonesia, and then South Korea, and then, eventually it went to Russia. So this is the thing. I mean, digital currency. I mean, it's. I mean, we have read a lot about how we are sort of coaxed or pushed into accepting the idea of digital currency, cashless society, and everything else. But then behind the story or behind the curtain thing, the story is that the digital currency growth would then impact the what do you call that, conversion to more and more negative interest rate. Okay, so negative interest rate, What do you think? Is it good? You are supposed to be paying for keeping your money in the bank. So this is something else. Okay, so gold's resilience definitely has been proven from time to time. So these are the 3 points. Okay, gold is insurance, gold is persistent, gold is resilience. All right, now I would like to then move on at the moment to just a chart, and but before that, there's a couple of other interesting things I would like to show you. We have got, give me a second, I'll just, okay. So I'd like to show you a little bit about geometric patterns and on how I actually trade, and would like to show you charts for gold. But firstly, I mean, it will only take about a couple of minutes to show you what my idea is on geometric patterns and some easy steps. Only 5 easy steps in less than 5 minutes in drawing a geometric pattern. Now, you guys probably heard about the ABCD pattern or the lightning bolt type pattern. I'll use that as my base of pattern that I draw. Okay, and the ABCD pattern is one of my favorite because there's many other geometric type shape that I could draw. In analyze, I would draw and use it to analyze the market. So ABCD pattern that is, and it just simply looks like this. If you've got your bullish pattern, got your bearish pattern, a lot of most traders, including myself, would use this pattern hand in hand with Fibonacci to confirm the C point and various other points, in especially the C point, in order for us to then project or find the D point. So in this ABCD pattern, of course, it's never a straight line when you're actually trading. You've got your ABCD pattern, and we would wait for an ABCD pattern to form following the A to B leg, the B to C, and we'll be looking into trading anywhere between C to D usually, whether it's the bullish ABCD or the bearish ABCD pattern. Okay, so once we attach these patterns, the lines of each pattern, you'll get a sort of geometric shape like this. And if at all you're actually attaching the line between A and D as well, you'll get a cross point in between. And that's also a critical area for me to understand how I could be planning my entry points as well, just by drawing this kind of pattern. Okay, so I don't use any sort of EAs or anything like that. I prefer to not only trade but teach those who attend my webinars or even seminars and workshops to actually draw them manually. Okay, so they could actually have a feel and have fun drawing these lines onto their chart. Okay, so it all starts visually, of course. I mean, once you've actually zoom out your chart, we'll do this step by step once we go into our MT4. Could easily look at a pattern like that and look at a rise up, and then whether or not you find a correction. Okay, so the first rise up from a low to the high, that's one line, and that could be your A to B, and then you've got a fall from the high area to the low, as it is as they are actually circled, as you can see in gray. So that's your A to B, and then your B to C fall, and we are looking at a potential what do you call that, D area. So once you've sketched that, from low to high, high to low, that's how an ABCD rough sketch would actually look like. Okay, so drawing of the first leg. So your first leg is from your low, your first low there, as you can see. Now once you zoom out, you just try imagining that everything moves in a straight line. Of course, you just want to attach a line from the low to high, so that's your A, that's your B. Okay, that red line. Then you've got your second line, your B to C line, that's your second leg. Okay, and then it goes to your third leg. Now the third leg, it's simple. Once you've drawn your A to B, that A to B, you double click that, and we'll do that live onto the MT4 chart in a bit. And that same length, you could actually mirror that length to be similar to the C to D. I think I've got a bit of an error there. I've typed C to B. It's AB equals C D. Okay, D for Denmark. So AB's length, just draw that straight line, double click it, and pull it from C to D, and make sure they're similar in length. So that's AB equals CD. So the end area here would be where your D could potentially be. Okay, so that's your A, B, C, and then your D. That's your first way of making that sort of projection of where D could actually lend. So that's your area there where it could actually roughly lend. Okay, so that's your first way. You've got a second way as well. You're probably your B. So that's your D projection. I've just draw there. Your first leg equals your second leg. Okay, the third leg actually, because your AB equals CD, right? And then you've got drawing these shapes. When you've attached it, you've got that sort of a geometric type pattern. Okay, they're actually quite interesting. Okay, now this is we have got price. Give me a second. We've got a second way of you know, projecting and finding that D point as well. I'll just show you here. Okay, and once you've actually pulled, I mean, earlier on, we've got your AB equals CD. We'll do all this step by step onto your chart anyway, so don't worry. Now, once the C point is at 38.2%, you've got an approximate D point at either 2.24 extension or the 2.618 by pulling your B to C. Okay, so perhaps it's a little bit confusing at this moment of time, but I'll just draw and give you an idea. This is your second sort of option or TP point. We're given about two simple options, two simple ways would give you two possible TP area for the D point. Okay, so there you go. Now we'll just do that quickly. It's probably less than 5 minutes here once I've showed you that. So let's go on to gold. Okay, give you a bit of an idea. Now, let's say we zoom out a little bit. I'll share with you an ideas that I would be looking at. Okay. Now, let's say we've got it on a 1 hour chart. Okay. We have got a movement, right? Let's take that movement here. Okay. And I'll draw the first leg. I'll draw the A to B leg, let's say. Okay. We've got A to B right there. Okay. And then C to D right there. So I've got my A to B. Yeah. Let's just draw it leg by leg. Yeah. A to B. And then once we have actually drawn A to B, we've got your B to C right there. And if your AB equals your CD, then you just simply double click that, move that across, and you have got your AB, okay, equals CD. So let's run about there. Okay, that's where D could potentially be, if at all. It's, you know, it's making a bit of a correction at the moment here. May not be a bit. It's got a bit of a correction there, but we have got options where we could actually see it as A, B, C, D, but there are various other ways to actually look into whether or not it's better a bullish ABCD or a bearish ABCD. Okay, so if at all we are not looking at a potential ABCD this way, and it's got more reasons to believe that you've got a bearish type pattern, then you could simply treat this one here as your A to the B, and then you have got, I mean, with all the due diligence you've done on researching the market and the trend and everything else, it gives you more hints to the downside. And you've got A to B, and you want to project that C to D. What you do is you just double click that to make that C to D move. Okay, so that's your C to D move right there. Okay, so this is a first. This is the first sort of move that you could actually project to be, if at all, it's on the downside at 129757. We will adjust that usually based on psychological numbers as well. Okay, and then here we have got another move right down here. Okay, that's the original leg, the first leg, the A to B. I'm just redrawing that again. So there you go. You've got an A, B, C, D sort of pattern. Okay, you can always convert that into a geometric type pattern. Okay, I'll just attach all these lines here. All right, and I'll continue doing so right there as well. Okay, and what I'll usually do is I like to find the cross in between, meaning I'll just attach this line as well all the way to the very end. Okay, and I get that cross area. Okay, so what does that cross area actually do for me? What it does for me in this geometric style trading is to give me an ideal area, um, to actually enter a sell. Of course, some of you guys would actually be looking at me and thinking, oh, there are ways to actually be entering much earlier, which is true. I agree. I'm sort of a conservative trader, so I would prefer to use this center point as an area that would gauge an ideal entry point upon crossing it underneath, under the 1324.97 area that's marked by this green horizontal line, following this centroid or center point here. Only then I will be looking at shorting it and aiming it right here at the D point here. Okay, so that's how I would be actually trading usually based on this. It all depends. It's not just this one area. I would then marry that up with some fundamental factors, polish the entries according to the psychological levels as well, and perhaps use some indicators to confirm trend as well, and go over various other time frames, and then measure the risk to reward ratio, a couple of formulas to actually uh, adopt to give me a better idea on how I would be managing my lot sizes, as well as my positioning, my position sizes. Okay, yes, and this is basically it. So yeah, let me just go on to. I've not actually even checked on whether I've got some questions there. Give me a second. All right, I don't think I've got any questions here. Okay. All right, so that is basically the style that I would do into what do you call that? Applying geometric trading onto gold. You can always do the same on various time frames, whether it's shorter or longer. We have got a bit of a um, perhaps different type of pattern, longer time frames. I've got various patterns that I could turn that into a geometric type pattern. Okay, if I go into the daily chart for gold at the moment, I mean, we have looked into various elements of what gold is expected to do, is to have a bit of a rise up. So this one here would be us giving the patterns basically are used to give us more hints on movements as a whole. So here itself, let's say